Hey everyone, welcome back. Today, we're diving deep into the US dollar liquidity situation. It's a bit of a puzzle right now. On one hand, we're seeing some strong signals for a short squeeze in crypto. But on the other hand, liquidity is draining fast. So, is this the bottom, or is it a trap? Let's find out together. Alright, let's kick things off with today's main focus. The market is sending us mixed signals, and I want to unpack that core contradiction right now. It's the key to understanding what might happen next. So here's the core contradiction I'm seeing. In the short term, we have funding rates turning negative, which is a classic short squeeze setup. But, and it's a big but, the medium-term trend, as shown by the 30-day moving average, is still solidly bullish. So, to sum it up in one sentence, short-term bears are growling, but the mid-term bulls are still in charge. The question is, who wins this battle? Now, let's get into the hard numbers. I've compiled a snapshot of all the key indicators I'm watching right now. These numbers paint the picture of the current market environment. Let's look at the macro and liquidity data first. The market is now pricing in zero chance of a rate cut in June. The dollar index is slightly down. But the big story here is liquidity. The on-RRP dropped by a massive $190 billion in a single day, and bank reserves are still below the critical $3 trillion level. The government is also draining liquidity through the TGA account. Now shifting to assets. Gold is bouncing back, which is a good sign for risk appetite. Oil is down. In crypto, both Bitcoin and Ethereum are up on the day. But the most crucial data here are the funding rates. Bitcoin's just turned negative, and Ethereum's has been negative for 6 days straight. This is a huge red flag for shorts. This is where it gets really interesting. Look at the midterm trend. Both Bitcoin and Ethereum's 30-day moving averages are still positive. That tells me the underlying uptrend is still intact. Meanwhile, ETFs saw outflows again, and sentiment is still in fear territory. So we have this divergence, short-term pain, but mid-term gain. Alright, let's zoom in on liquidity. This is the lifeblood of the market. If it's drying up, it doesn't matter how bullish the setup is, things can get ugly fast. This is the most worrying part for me. The on-RRP facility, which acts like a liquidity buffer, is down to $387 billion. That's a huge drop. Bank reserves are also still below the critical $3 trillion level. And on top of that, the government is sucking even more money out of the system. The liquidity pool is shrinking rapidly. So, my overall assessment is this: liquidity is draining fast, which is a major risk. But the market is at a crossroads. We have short-term signals pointing to a squeeze, while the mid-term structure still looks bullish. It's a classic battle between different time frames. Now let's move on to the key signals I'm watching. These are the factors that I believe are actually driving price action right now. We'll start with the strongest one. This is the strongest signal by far, and it's a divergence. Short-term indicators like the funding rate are flashing red for bears. But the mid-term trend, as shown by the MA30, is still green for bulls. This means the market is at a crossroads. We don't have a clear direction yet. We need to watch which side gives in first. The second signal is the liquidity drain we talked about. The on-RRP is getting dangerously low, which could put a ceiling on any rally. But the third signal is more positive. Gold is bouncing back, and the fear index is slightly off its lows. This suggests the extreme panic is easing, which is a good sign for risk assets like crypto. So, with all these conflicting signals, what happens next? I see 3 possible scenarios playing out. Let's break them down, starting with the most likely one. Here are the 3 scenarios. Scenario A, the most likely at 50%, is the short squeeze winning out. If Ethereum breaks $1,700, we could see Bitcoin rally to $68,000. Scenario B, at 30%, is a period of consolidation where neither side wins immediately. And scenario C, at 20%, is a liquidity crunch causing a retest of the lows. Now, let's talk about the anomaly. This is the internal conflict I see in the market right now, and it's what makes this moment so interesting. The anomaly is this rare divergence between short-term and mid-term signals. We have a strong short squeeze signal from the funding rate, but the 30-day moving average is still telling us the trend is up. These two opposing forces are creating a lot of tension in the market right now. Alright, let's wrap all this up with a one-sentence summary. This is the bottom line of my analysis. So here's my bottom line. The market is stuck between a short-term squeeze setup and a solid mid-term uptrend. The direction is unclear right now, we're just waiting for one side to overpower the other. For now, I'm watching three key signals: the ETH funding rate, the MA30 direction, and the on-RRP trend. To make it simple for you, here's my personal checklist of what I'm watching in the coming days. These are the levels and indicators that will guide my next move. First, watch the ETH funding rate. Does it stay negative or reverse? This will tell us if the short squeeze pressure is increasing or fading. Second, monitor the MA30 direction. If it flips negative, the midterm trend is in trouble. And third, keep an eye on the on-RRP and see if it continues to fall towards that $100 billion line. These three things will tell us everything we need to know. Before we go, I need to remind you that this is just my analysis and not financial advice. The market can change quickly, and past performance is no guarantee of future results. Always do your own research.